So we've been looking at leases, and so far we've looked at finance leases for a lessor and a lessee, and we've also looked at operating leases for a lessor and a lessee. That's what we've done the last two lectures that we had. Today we're going to look at, from a lessee perspective, a sale and leaseback, finance sale and leaseback, and an operating sale and leaseback from a lessee perspective. And we're also going to look from a lessor perspective at a manufacturer or dealer lessor. And both of these things that we're going to look at today have one thing in common, and that thing is profit on sale of an asset. And when we have profit on sale of an asset, the question we ask ourselves when it's a lease is, how do we recognize this profit on the sale of this asset? Is this really profit or not? And how do we recognize it in our books? Because if you are a lessee and you do a sale and leaseback, here you are. You sell the asset to someone, a bank, and then you decide that you actually still need the asset, so you lease it back. That's what a sale and leaseback is. And when a company does a sale and leaseback, there's one transaction which is a sale on which the company makes profit selling an asset, or a loss selling an asset, and then they lease the asset back. And when they lease the asset back, then we have a normal lease, isn't it? When the company has a sale and leaseback, it could be a finance sale and leaseback. A finance sale and leaseback, we haven't actually sold an asset, have we? We technically have sold an asset, but all we're doing is raising finance. And the only way we have to raise finance is to actually sell some of our assets. But we still need them, so we lease them back again, isn't it? So a finance sale and leaseback is just a financing transaction. I need to borrow money, I'm desperate. And so the only way to do it is to sell my assets and then rent them back. Or it's an operating sale and leaseback whereby I actually don't need the asset in the long term. And so I only will rent it back for a short while, and that happens if I have bought a new asset. So if I have ordered a new machine and it's going to cost a lot of money and I need a deposit for that new machine, one of the ways to finance the new machine is to sell the old machine and then lease the old machine back for a little while, 6 months, a year, until the new machine is ready. And then I don't need it anymore, isn't it? So it could be an operating or a finance sale and leaseback. But in both cases, I am actually selling an asset. So I have to ask myself, have I sold an asset or not, is the first question. Is there profit? How do I recognize that profit? That's for the sale and leaseback. For the manufacturer dealer lessor, which is the one we're going to deal with first, this lessor is a manufacturer or a dealer. So actually, he is entering into a lease for his inventory, isn't it? It's not a PPE in his books, it's inventory. If he's a manufacturer, I had a client who made forklifts. They made forklifts, and then some of the forklifts that they manufactured, they sold. Some of the forklifts they manufactured, they leased out, like you would lease out a car. Some of those leases were long leases, so they almost were like finance leases. Some of the leases were short, like if you needed a forklift for the weekend, you could just go hire a forklift. So in this case, this company is a manufacturer of forklifts, and they're entering into a lease for those forklifts. So it's actually inventory that they are selling, isn't it, if it's a finance lease? Because we're selling this inventory, but we're not getting paid straight away, we're getting paid over the period of the lease. And so do you agree that there will be an element of profit, gross profit, gross margin, when I enter into a finance lease for something that in my books was inventory? And it could have been inventory because I manufacture it, or it could be inventory because I'm a dealer. So it could be that I'm a car dealer and I buy and sell cars. I don't make cars, but I buy and sell cars, and I enter into some leases with those cars. There'll be a portion which will be profit, and then because I've entered into a financing arrangement, there'll be interest as well, income, isn't it? And so there's a little bit of a trick there. I'm going to start with this one. It happens to be the one that appears first in your study guide, so that's the one I'm going to start with. All right. So, manufacturer, dealer, lessors. The first thing, I suppose, is what I've already said to you, is the fact that we are selling inventory. And so the journal entry that we learned to do earlier, which had a credit going to PPE, do you remember? We debited gross investments in finance lease and then we credited PPE, is actually going to be an entry where we're going to debit the gross investments in finance lease, credit unearned finance income, and credit revenue, because I have sold an asset, yes? And I've sold it and I haven't yet received the money, so I have a receivable. And then I'm going to have an extra entry, which is when I debit cost of sales and credit inventory. Yeah? And this first entry will be at selling price. This second entry will be at cost. And then I'll end up with gross profit. Agreed? I'll end up with gross profit, and I also then land up, as all my other lessors land up, I'll end up with this financial asset. And then I amort it, and I do the calcs, and etc., etc. Okay. So that's the first thing with the manufacturer, dealer, lessor, is that you're dealing with inventory. The second thing that I want to point out is that with a manufacturer, dealer, lessor, transaction costs are considered to be the costs of selling inventory. And therefore, they go to P&L. Do you remember when we had the lessor, we added the transaction costs to the lease? We even did it in our assignment, isn't it? But when we have a manufacturer, dealer, lessor, transaction costs are deemed to be costs of selling inventory. They land up in P&L. They don't land up in the gross investments in finance lease. So that's the second thing. The third, and this is the most important of them all, has to do with leases where the interest is less than market I. When I enter into a lease and the interest is less than the market I, what the statement says is that this is actually a discount on the inventory sold. And the other thing that the statement says is that you must calculate do your amort and interest calcs on market I. So let's look at what a typical example of a transaction like that is with cars. BMW is bringing out a new model, so they want to get rid of some of their older models. They don't want to discount the car. It affects the brand, isn't it? It affects the value of the brand. So they don't say, you can come and buy an old BMW because there's a new one coming out and we'll give it to you at a 50,000 Rand discount. No, they say, come and buy a BMW today and don't pay interest until next year. Isn't it? You see those adverts. Or pay interest of only 5%. You see those, isn't it? What does that do? You pay less for the car, but you still believe you've got this fancy car that costs that big amount of money, isn't it? Because in your mind, you got it at a low interest. But actually what you got was you got a discount on a car. You got a car that's worth less. And when you try to sell it once the new model comes out, you soon realize that you have a car that's worth less, isn't it? So what the statement says is that when a manufacturer dealer lessor enters into a lease and the lease is below market interest, that actually what he's doing is he's discounting his product. And we actually have to discount the product, and we have to reduce this selling price, and we have to reduce the profit that he recognizes when he does the sale. When we then recognize interest, we will recognize interest at market I. That's what the statement says. All right, so let's look at the example. It's in your study guides. I don't know, this thing isn't working at all today. I don't know what is wrong with it. Oh, maybe I need to put my pen down and just try with my finger. No, it doesn't want to pick it up. It doesn't want to. Okay, we're looking at example 12. It's a big section of work. We've already done 2 weeks of work on it. This is our third. Example 12, and for some reason the page number which shows at the bottom isn't appearing. So if you can find it for me, page 250. 250. All right, so we look. Laser manufactures machines, and then it sells or leases these machines to customers. They leased a machine to Jet Limited on the 1st of January. The following information is available. The cost of the lease machine is 80,000 Rand. The selling price was 110. So at face value, it looks like we made 30,000 Rand profit selling this machine. We entered into a 4-year lease. The lease installments are payable annually in arrears, 36,000 Rand, 216 Rand per annum. And the interest rate implicit in this lease is 12% per annum. A market-related interest rate for such a transaction is 18% per annum. We don't have market I, isn't it? So the first step is to work out what would the PV be. What is the value? Let's rather say it like that. We have to ask ourselves, what is the value of 36,216 Rand per annum for 4 years at a market I of 18%? Because that's actually what I'm getting for my car, isn't it? Or my machine. So that is step 1, if you could do that calc for me. What is the value of 36,216 per annum over 4 years at 18%? That will give me a PV at 18%, not 14, sorry, 18%. Where's my little calculator thing? $97,423. $97,423. So, actually, what we've done is we've sold an asset for $97,423, isn't it? We've sold an asset for $97,423. We're going to receive the money in 4 installments, 36,216 per annum, at a market I of 18. And so the profit that we've made is not 30,000 Rand. The profit that we've made is only 17,423. Yeah? And then when I amort, I'm going to amort this present value and that amort table. Okay, so if we look at the solution, that's the only extra step for manufacturer dealer lessors. We say to ourselves, if the interest rate is below market I, then I have to work out what actually have I sold the asset for using market I. So what is the value of those installments at a market interest rate? The value was 97,423. So if we look at the solution, which is on the next page, They've done a PV. They've said that's the present value. There were some legal fees. Were there some legal fees in the original question? Did I not read the rest of it, the question? I didn't read the rest of the question. Laser incurred 5,000 of legal fees to secure the agreement. At the end of the lease period, the machine will be transferred to Jet at no additional cost. It's a finance lease, right? So I have sold the asset. The 5,000 legal fees will go to P&L. Normally, I would add the 5,000 to the 97, but now I'm not going to because it's considered to be cost of selling inventory. Okay. Let's look at what the calculation is. They do that PV calc. They land up on a PV of 97,423. The 5,000 of legal fees, they say there, will go to the P&L. And so I do an amort table. The amort table is the 97,423 and lands on 0 after paying 4 installments of 36,216. Yeah? And here's the interest capital amounts. The journal entries, legal expenses, bank. I expensed the 5,000. Then, as I gave you the journals in the beginning, do you remember? Our normal journal would have been one journal, and it would have been to PPE. But this is now inventory, so it's 2 journals. Gross investments in finance lease, unearned finance income, giving us revenue of 97,423. Remember where these numbers are coming from? This is the total of the installments, isn't it? What was it? 36 something times 4. Yeah? Your 4 installments. And then this is the balancing figure. It's the interest. Or from your amort table, you can see it's up there, right? But there's the number, 36,216. I'll just circle it up here. So there's the numbers up there, yeah? Giving me revenue of that. Cost of sales, inventory, the 80. Then in the first year, I will receive an installment of 36,216. As you know, the installment goes to no, why? The installment goes against the gross investment, and then the interest piece goes against the unearned interest. Yeah. So when we do lessees, this is one journal, but when we do lessors, it's 2 separate journals. The gross amount against the investment, and the gross amount received against gross investment in finance lease, and then the unearned piece going to P&L as interest income, yeah, a credit. From a SARS perspective, this asset becomes PPE. Yeah, no, wait. From a SARS perspective, this is a lessor, right? From a SARS perspective, yeah, this asset becomes PPE because we are saying we sold inventory, but because it's a lease, SARS says you're leasing out an asset. Yeah. So let's have a look quickly at the tax and deferred tax calc. Sorry, those are just the rest of the journals for the rest of the year. Sorry, I'm going to just have to do it from here. It's driving me insane. Okay, here's the note for the net investment in finance lease, which is exactly the same note that you remember seeing. Yeah. And you'll see that here they talk about the interest rate in the lease being the 18% because that's what we've massaged it to be. Yeah. At the bottom of the page here, the deferred tax. Calc 2. Here's the calcs. See here? What we had as cost of sales and inventory gets taken out. Yeah, we showed revenue and we showed a sale. So we showed revenue and cost of sales. SARS says no, that revenue cost of sales is actually, you didn't sell anything, so there's no cost of sales. And he says that revenue is now, or that inventory now becomes a capital asset for tax. Yeah. So then what he does allow is he allows a tax allowance on the machine. Here it is. Yeah. Okay, so Calc 2, I think, has the temporary differences or the deferred tax. It's easier to see there. Yeah, so what you can see here is that this one looks the same as the other ones, isn't it, that we always did. In our books, we have a receivable. SARS says, no, you don't. And for SARS, he has a machine, which in our books we're saying, no, we don't, isn't it? And basically, when we have a manufacturer, dealer, lessor, in SARS's books, that inventory becomes a capital asset, a machine. Yeah. So that's manufacturer, dealer, lessors. Remember I said to you at the beginning of the lecture that our lecture today is going to be all about profit. Oh, don't understand. That our lecture today is going to be all about profit. So if I just go back to the beginning here, I said to you we're going to look at sale and leasebacks and manufacturer, dealer, lessors. Because in both of these transactions, there's a profit on sale of an asset, and we need to figure out what to do with it, right? So when you have a manufacturer, dealer, lessor, if you sell at a market-related interest rate, your only difference is here, which is I'm not selling PPE, I'm selling inventory. So I have a revenue cost of sales entry that needs to go in, and any transaction costs go to P&L, yeah? If I sell at below market interest rate, if I enter into the lease below market interest rate, I have to calculate the discount on the inventory sold. It's the difference in the interest rates, isn't it? And I do an amort using market I. Yeah. The next piece is sale and leasebacks. Let's talk about sale and leasebacks. There's two different types of sale and leasebacks. When we do sale and leasebacks, we're looking at them from the lessee's perspective. Do you agree from the lessor's perspective, it's exactly the same? Somebody sold him an asset and now that he's leasing it out. Whether it's a finance lease or operating lease, from the lessor's perspective, it's the same. It's just from the lessee's perspective that there's an extra piece, which is, have I sold an asset and is there profit or not? Because the lease part is the same. It's fine, isn't it? So what do we have? We have an operating sale and lease back. Let's do a finance one first. Sorry, finance ones are easier. I have a finance sale and lease back, and I have an operating sale and lease back. I'm going to do the finance one first. Finance sale and lease backs are not a sale. If you remember the picture that I drew for you, the company sells an asset to the bank, but they still need the asset. They lease it back from the bank. It's a finance lease. So have I sold the asset? No, it never leaves my premises. It will never leave my premises. It stays there. All it is, it's only a financing arrangement. And if you look at the journal entry, you'll see how it is only a financing arrangement because I sell this asset to the bank. The bank gives me money, isn't it? Debit, bank. The bank gives me money for this asset that I've sold them. But then I have to pay back the bank. How am I going to pay back the bank? Through a finance lease, isn't it? Credit, finance, lease liability. What happens to the asset? Nothing, because I had an asset and I still have an asset. Yeah. So it's only a financing arrangement, and the journal entry is to debit bank and credit a finance lease liability. This finance lease liability over here, I'm going to amort, just like I did when it was a normal finance lease. Yeah. So there is only one more thing that is a little bit strange with the finance lease liability. We don't sell the asset, but we will adjust the asset. And we will adjust the asset for two things. We will adjust the asset by an amount to increase it to selling price or fair value, because I've sold an asset in legal terms, isn't it? Not in substance, but in form. In form, I sold my asset to someone. They bought it from me at a certain price. So we have to make an adjustment whereby we're going to adjust the carrying amount of the asset up to the selling price or fair value. So I'm going to just say carrying amount must go up to selling price or fair value. The journal entry for that is to debit PPE and credit deferred income. Deferred income. This deferred income I will amort over the lease term. Okay, we're going to look at an example. But I'm the lessee. I entered into a finance sale and lease back. I've sold my building to the bank or my car to the bank. The bank has given me money for it. Debit bank, credit, finance, lease liability. I had an asset in my books. It had a carrying amount, 50,000 Rand. The bank paid me 70. So one of the rules is I have to make my asset. There was a transaction. It was arm's length between two parties. It reflected that my car was worth 70. So I will adjust my car to be 70, yeah? And the other side will go to a deferred income account. That deferred income I will amortize over the lease. The other thing that I will do here is I will add the lease costs. Isn't it? I will add the lease costs. And I will then have a new carrying amount. And there's something I've forgotten. Damn. Okay, I just want to move all of these things down slightly. Because there is one thing that I've forgotten, and that's that I have to reclassify the asset. Reclassify from owned to leased. But that's just an in and out journal, hey? Out of owned asset into leased asset. Sometimes you see it though if they ask you for the journals. And when you see these assets, you remember when we had leased assets, it says leased machine, hey? So do you agree this machine was owned machine, and sometime during the year it became leased machine? Okay, so it's just a technicality. So the first step is actually to reclassify the asset from owned to leased, and then I adjust the asset value. From carrying amount, I adjust it up to selling price. I add the lease costs, and I have a new carrying amount. This new carrying amount, I have to determine a life at this stage. Remaining life. Yeah? Life remaining. Because I'm going to depreciate it now over the remaining life. Do you agree? It no longer is the carrying amount that it was at the original cost. It's changed. If I carry on depreciating on original cost, I'm never going to get to zero or to the residual that I need to get to. Okay, so I have a new carrying amount. I have to depreciate it over the remaining life, and I start my depreciation calc from scratch. All right, let's have a look at an example. I'm going to let you do the calcs for me. So the example, I think, is the next one, 13. We were on 12, right? No, it's 17. 17. Let me see if I have a number, page number. No, man, stop it. 279. 17. 279. Okay, so on the 1st of September, Stanton sold its machine for 240,000 Rand in terms of the sale and leaseback. The carrying amount of the machine at the end of the previous financial year, which was March, was 210. At this date, the tax base was 56. The machine was purchased on 1 January for 280. Depreciation is straight line at 20%, apportioned for the year. Residual is null. SARS allows a 12C allowance, 40, 20, 20, 20. The remaining useful life of the machine at the date of the sale and leaseback was 3 years and 4 months. We don't like to work with years and months, so I don't know. I would just go straight into months. 3 years, 4 months. Okay. The lease installments are 8320 monthly in arrears from 30 September. for 3 years. So 36 months, that installment. They incurred legal expenses of 4,300 to secure the lease, which was not deductible for tax purposes. So I want you to do 2 calcs for me. I want you to do the amort on the lease, and I want you to do the calc on the asset. Yeah? So the calc on the asset, the amort on the lease, and then we'll go and check the numbers in the disclosure. Okay, I think they ask disclosure. What do they ask? Journals? They ask for journals as well. And the notes. Yeah, let's just do the calcs, and then we'll work through the journals and the notes. Okay, so just do the calcs for me. The first calc you can do, it can be the amort table, and then the second calc you can do for me can be on the asset. And there's also a deferred income, so when you do the asset piece, do the deferred income piece as well. So 3 calcs. Amort the finance lease liability. Do the calc for me for the short term and the long term, because this is a piece of a year, so I want to see if you remember how to do that. We did it last time. Okay, so I want finance lease liability balance at year end, and I want non-current and current, and I want the interest for the financial year. I want the interest expense, interest in the profit before tax note. And then for the asset, I want the carrying amount at the end of the year, and I want the depreciation. And then for the deferred income, I want the carrying amount at the end of the year. You know that with deferred, anything deferred, we have a current and a non-current. I need you to just split it for me. And I want the amort amount that will be in the profit before tax note. So those are the numbers that I want. Shall we have a look? Okay, so the first thing I asked you to do was the finance lease liability. It was monthly. So all you needed to do was work out how the months worked, isn't it? So in the current year, it's period 1 to 7. I hope you can do that on your calculator so that you don't have to do 1 and then 2 and then 3 and add them all up, isn't it? You should be able to say period 1 to period 7. What is the interest? Period 1 to 7, the interest was that. I don't know, the interest is 2 rand out. I think my eye maybe came out a bit different, I don't know. And then period 8 to 19 is the next year, the next 12 periods, isn't it? And if you go period 8 to 19, the capital portion that will be paid in that period is 74,626, and the balance at the end of that period is then 126,714. Yeah, and that 201,340 is the balance at the end of period 7. I'll just put there, balance at your end, period 7. So you needed to be able to do that. Yeah, end of the current year, period 7. End of the next year, period 19. If you wanted to do non-current, you could say from 20 to 36, what is the capital portion? And that would have also given you the 126,714, isn't it? So this is, you could have said period 20 to 36, and it would have given you that capital. Okay, so that you needed to be able to do so that you can put the numbers into the note. Yeah, this goes into profit before tax. That goes into the other note and the recon. We'll have a look at the notes now. Then the asset, I start the year at 210. I depreciate for 5 months. 23,333. It's 20% straight line on 280. Cost was 280, 20% straight line for 5 months. 23,333. I land on 186,667. I've got to bump that up to 240. I've got to add the costs of 4.3 because I've take the carrying amount, bump it up to selling price, add the costs. I land on 244.3. At that time, they told us there were 40 months left. You could have been expected to work backwards. You would have been able to do that from the carrying amount. So there are 40 months left. I'm going to depreciate 7 more months. In total, I will have depreciated for a full year. 5 months before the sale and lease back, 7 months after the sale and lease back. So I depreciate for another 7 months, 42,752, and I land on 201,548. 201,548 is my carrying amount at end. Depreciation is the 5 months plus the 7 months, 66,085. The deferred income is this movement from carrying amount to selling price, is the deferred income. 53,333 to get me from 186,667 to 240. That I'm going to amortize over the lease term, over 36 months. So over the 36 months, I'm going to amortize it for 7 of those months. Divide by 36 times 7 gives me that. Gives me that as the carrying amount on that deferred income. In the next year, it will be 12 months. It will be that number. So then the non-current will just be the balancing figure. Yeah. So of that 42, in the next year, I'm going to amortize 53333 divided by 36 times 12. It gives me that number, 17,778. And then the balancing figure is the non-current. And then there's the amort. So that's a finance sale and lease back. So it looks like a finance lease still. What you'll see is that it looks like a finance lease. They ask you to prepare the notes, but they miss some notes. I don't understand really. Let's just go through them and see what they've got. They start with the statement of financial position. 158. Is that what we had for the asset? No, that isn't what we had. Okay, well, let's have a look at the notes. Oh, they take off the deferred. Okay, here's the note. Yes, of course. Okay, so here's the note for PPE. Oh, man, come on. I was looking for this PPE note and I couldn't find it. Okay, here it is. Here's the note for PPE. I start with a carrying amount of 210, which is 280 less ACDEP. I then depreciate 23333 and I land up with 186,667, which I transfer to leased machines. Reclass, owned to leased. Then once it's in leased, I do an adjustment to get it up to the 240 and I put in the costs and I land on 201,547. That 201,547, then I depreciate, there's the depreciation, 42,752 and I land on 201,547. The 201,547 is made up of a cost piece. The cost piece is the 186 that it was transferred in at, plus the 53 adjustment, plus the 4 of costs, and a depreciation piece, which is just the current year's piece of depreciation. And then at the bottom, I remove the deferred profit that will be recognized in future periods, 42,963. You have two options with this deferred profit. You can either remove it here so that your asset stays small, or you can show it as a liability, as deferred income. Both methods are, I think, acceptable. They used to show it separately, and now they've changed it to show it together. So I think for your purposes, learn it like this. Less deferred profit to be shown in future periods, giving you that balance that it's in the books at. Then in the profit before tax note, we have the income that was amortized, the 10. We have the 2 bits of depreciation, and we have the interest from our calc. 2 rand out. They then do a tax and a deferred tax note, which I'm not going to really worry too much about. I'll talk to you about tax now. We do a finance lease liability note, and here's the amounts for our finance lease liability. Total, non-current, current. And then the lease payments is just 12 months, the rest of the months, and the rest of the months. And the story. So that's finance lease, sale and lease back. I'll talk to you about tax at the end because you know that SARS doesn't treat finance and operating leases differently, hey? Because to SARS it's the same thing. We're the ones that separate finance and operating leases. SARS does not. But I'll talk to you about SARS later. All right. The next one that I wanted to look at the journals. The journals forward. Here they are. Okay, you'll see the very first journal they do is the reclass journal. Yeah, the reclass journal to reclassify machinery from owned to leased. So cost and ACDEP comes out and it goes into leased at 186,667. They also put depreciation in to get us to that point. We could have done 2 entries. First depreciate to get us to that date, then transfer. Then once it's transferred, we then enter into the sale and lease back, and the entry is bank and lease liability. And then I would do those 2 entries separate. Bank and lease liability, the 240, and then increase the value of the asset with the amount to get it up to 240 with the deferred income. Then in the current period there were 7 installments. There's the 7 installments all in one. And there's the legal fees which are going into the machine. And then at the bottom is the depreciation on the machine for the rest of the year. And then they do a tax and an income tax, a deferred tax and a current tax journal. Okay, let's talk about sale and leasebacks, which are operating sale and leasebacks. Okay, so operating sale and leasebacks, we are selling an asset. Yeah, I am selling an asset and renting it back for a short time. So operating sale and leasebacks, sell asset. That's the first thing. And then lease the asset. And I'm going to put in brackets rental. The main issue with an operating sale and leaseback, strangely, is actually here. It's in the sale of the asset. When I sell the asset, I obviously am going to make a profit or a loss on the sale of the asset. And the statement, once again, looks at this profit and loss and says the following. The profit or loss that you're going to recognize on the sale of the asset must be the difference between carrying amount and fair value. Carrying amount and fair value. If you have sold the asset at above or below fair value, the amount from selling price to fair value, if it goes like that or like this, do you agree? Because I could have sold above or below fair value. So if my selling price is below fair value, then there's a piece of loss over here, which I'm going to defer. And if I sell above fair value, there's a piece of profit here, which I'm going to defer. There are reasons why fair value may or may not be the same as selling price. Yeah? Usually we assume fair value is the same as selling price, isn't it? But if you put yourself in the position of this client, of this company, all they need is that deposit to put down on the new machine that they've bought. So they don't need the full value of their asset. They need a fixed amount of money. That fixed amount of money could be more than what your machine is worth or less than what your machine is worth, isn't it? And what you're going to do is you're going to go to the bank to ask for that amount of money, isn't it? So you are going to go to the bank and you're going to ask for a certain amount of money for selling price. But your machine is going to be worth either more or less than that selling price. This difference will be compensated in the future lease amounts. So let's look at 2 examples. I have a machine. My machine is worth, as a fair value, of 100 Rand. I actually need 120 Rand. Let's say it's millions or thousands. Yeah? So I go to the bank and I say, I need 120,000 Rand, not 100,000 Rand. And I'm willing to pay more when we do the lease payments. I'm willing to pay more if you give me the extra money. And he says, sure, because he's a bank, isn't it? From his perspective, it's just financing. It's a financing arrangement. What we're going to do is we're going to say, if the carrying amount of my asset was say 80, we're going to say, you're not allowed to recognize profit of 40. You're only allowed to recognize this as profit, and this piece you must defer. Yeah? And if you think about it, this is what's going to happen. You're going to put this deferred into your P&L. Yeah? It's a credit. Do you agree? A credit. Over the period of the lease, you will recognize that amount. Over the period of the lease, this credit will end up in my P&L. Slowly, 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 isn't it? Over that same period, your lease installments, these ones up here, are going to be too high because you have agreed with the bank that he can charge you more, isn't it? So over the period of the lease, your lease installments are too high, and they're going to be offset by this credit, which is going to come into the P&L to make it right. Do you agree that it makes sense? Yeah? The bank gave you too much money up front. You've agreed to pay him bigger lease installments later. But what we're going to do is that money that he gave you up front now, we're not going to recognize it as income now. We're going to keep it tucked away, and we're going to only recognize it as income over the lease. And as we recognize it as income, so it will offset the lease installments, which are too big. Yeah? We could also have the opposite scenario. We could have a scenario where we only maybe need 50,000 Rand. And I agree that I will sell it for 50. So normally I would show a loss of 30, isn't it? But the statement says, no, if you're going to compensate, and that's an important piece here, it has to compensate. It says, no, if you're going to compensate with the lease installments, so you're going to go to the bank and you're going to say to the bank, I have an asset. Its fair value is 100, but I don't need 100. I only need 50. So let's do this. We do a deal. You give me 50, I'll give you my asset. I'll rent it back from you only for a short period of time, for a few months. 6 months, 9 months, 12 months, whatever it is. And in that time, I will pay you half the lease installment, isn't it? Because you've only given me half of the value of the asset. In this case, I will still recognize this as profit. Sorry, I'll go back. This will still be profit because the statement says the difference between carrying amount and fair value is profit. Yeah? And then what I will say is now I'm on 100, so now I've got to go from 100 back down to 50, and I'm going to have a deferred loss, a debit, isn't it, for it to all balance. So I'm going to go from 80 to 100 and show profit, and then I'm going to have to go from 80 back to 50 because that's all I'm going to get from bank. So I'm going to have to show a loss, isn't it? A loss. So this deferred loss, which is now going to be a loss of 50, I'm going to again put into the P&L over the period of the lease, and it will offset that rental. This rule only applies when the lease installments compensate. If they don't say to you anything about the lease installments being different to fair value or different to market, then you ignore it. But they will always tell you that, isn't it? Because why would you sell an asset worth 100 for 50 if you weren't going to get cheaper rentals, isn't it? Why would you do that? Or why would the bank give you 120 instead of 100 if your asset's only worth 100? If he's not going to charge you more in rentals, isn't it? He's not going to do that. So this is the rule then for operating leases. It's all about the profit or loss on the sale of the asset. We are selling an asset. Okay, so that's a given. The asset disappears. We're going to de-recognize the asset, and we will recognize a profit or loss on sale. And the profit or loss on sale should be the difference between carrying amount and fair value. And fair value should be equal to selling price, isn't it? When fair value is not equal to selling price, and the lease installments are going to compensate for that because they will be different from market, then the rule is carrying amount to fair value is profit or loss, whatever it is. And then difference between fair value and selling price is deferred. It's either a deferred loss or a deferred profit, depending what comes out. You can see from my little calc here, we're always going up to fair value. If I'm going up some more, then it's more profit. Hey, profit. It's a deferred profit. And in my second example, I'm going up, and then I'm coming down. to selling price, isn't it? So then it's a loss. So if you draw it like that, you can see it. Otherwise, when you do it in journals, it's quite obvious to see. So the example is 18. Company A sold their building in terms of a sale and leaseback transaction. The cost of the building was 300. The selling price was 250. The carrying amount was 120. Tax base was 150. Fair value was 230. So here's the numbers that are important. I don't know if I still got the highlighter on. I do. Here's the numbers that are important. Carrying amount, 120. Fair value, 230. Selling price, 250. Yeah? The company provides for depreciation at 2% per annum straight line. Ownership will not transfer back at the end of the lease. Installments payable monthly, 5,000 Rand. Now I'm not sure. Yeah. Okay, so do the calcs for me quickly. Work out for me. When was the date? 31. Work out for me how much will be profit and how much will be deferred profit. And then we'll look at how that deferred profit is going to be recognized. I like to just put the numbers in order of so carrying amount is usually at the bottom, and in this case we have fair value next, and we have selling price at the top, and we have 90 there, 20 there. Okay, carrying amount was 120. We go from 120 to fair value, 230. And we recognize profit on sale of the building of 90,000 Rand. But we're actually going to get, 110. Can you believe it? 110. And now it's probably not purple anymore. 110. 110 profit. Then we actually will receive 250 in cash, so we will show the other 20 as deferred. Yeah. Journal entry. Debit, bank, 250. Do you agree the bank is going to pay you 250? We're going to de-recognize our PPE. Credit, PPE. I'm going to put it in like this, but you mustn't put it in like this. Hey, I always say that and then you forget. You must put in cost at deb. Let's put it in. It's just there. I don't have space for all my journals. Debit. Let me try and squeeze it. Credit, PPE, cost. What was cost? 300. And debit, PPE at deb, 180. Do you agree? There's my 120, my cost of my asset. I'm going to recognize profit, credit, profit, P&L, 110. And I'm going to defer profit, credit, deferred income, statement of financial position, 90. Does it add up? 3, 4, 500. It doesn't add up. It doesn't add up for squat. What have I left out? And I see there 20, and then I still write down 90. I'm obsessed with 90, eh? Maybe I should go and put some money on a 90 somewhere. 20. 330. Is it right? 430. 330. 330. And this one? 430. I'm thinking, why is the one 430 and the other one 330? because they're both 430. So if I just total up, 430 on that side, 430 on this side. Okay, so from carrying amount to fair value is profit. It goes into P&L, profit on disposal of machinery, building in this case. And then the rest, the 20, goes to deferred income and will end up in statement of financial position. It will then be amortized, in this case over 4 years. Yeah, that deferred income will be amortized over the period of the lease, because over that period we must probably are paying too high installments. Okay, let's have a look at the solution. They do the calcs the same as us. Here's the journals. Let me see if their journals are the same as ours. The first journal they do, yeah, it's the same journal, right? 330. And then, I don't know where they get the months. I think I didn't look at the year ends. But then here is the payments for the year, 5,000 Rand a month for 9 months. We pay installments on the operating lease. And you know, on the operating lease side, we would have to equalize, if it was unequal. Okay? And then we have deferred profit, which is being amortized. And look, over the period of the lease, 9 months, over the 4 years, over 48 months. Yeah. All right, let's look at another example, and then I'm going to talk tax. Here's disclosure. PBT, there's the profit on the sale of the building. There's depreciation on the building for the 3 months until it's sold. There's the lease expenses and the deferred profit, making your lease expenses smaller. Do you see? The lease expense was 45, but we had this deferred income that we're now recognizing, so the lease expense it's offset. It's smaller. Here's the note for the operating lease agreement, which is 5,000 Rand a month for 4 years. It looks exactly like the other operating lease agreement notes that we've seen with the story. Okay, here's another one. A construction company, Tech Build, I think you have to calculate the carrying amount of the asset, entered into a sale and leaseback on the 1st of August 2008. The asset was originally purchased on August 2006, so it's 2 years old. It's the company's policy to depreciate over 10 years straight line. The following information is relevant. The machine had a carrying amount of 220 and a tax base of 55. The lease term is 3 years, and installments are payable monthly in arrears. The lease installments are 8,860 per month. A fair rental would have been 10,100. So we can see from this that we are paying less than a fair market rental. So I'm expecting to see that we got paid less than fair value for our asset. Yeah, we're paying less than a fair rental. And here's the numbers. Selling price was 240. We got paid 240, but the fair value of the asset is 258. So in this case, we have a deferred loss, isn't it? So, I mean, it's actually easy to do. So from the 220 to the 258, so if I like to do my numbers in order. So here's the 220. Here's the 240, which is the selling price. Here's the 258, which is fair value in this case. Fair value, selling price, carrying amount. So I'm going to go up to there, and I'm going to show profit of 38 from 220 to 258. Then I'm going to go back to 240 because I'm only going to get 240 from bank. And so I have to go back by 18, and that will be a deferred loss because it is going back down. Yeah. The lease is an operating lease. They have the option at expiry to repurchase the lease, the machine, at fair value. So we can buy it back if we pay full price. So that's not a finance lease, isn't it? A finance lease is when we've paid for the machine through our installments, or when we can buy it for a minimal amount. Yeah, so that's that number. All right, let me talk to you about, I wonder if I've got more examples. Is this another one? 20. Okay, I'm going to, this is the one we just did, right? heck is going on here? Okay, I want to talk to you about SARS. You see, this one is not compensated. Do you see? Difference not compensated. So when the difference is not compensated, then we don't have to do any funny gymnastics. Whatever we got it for, that's profit. Okay, let me talk to you about tax with sale and leasebacks. So what happens with the sale and leaseback? The company sells the machine to the bank, and then the company leases it back from the bank. And that is exactly how SARS sees it. Yeah, so SARS sees that when you have a sale and leaseback, SARS sees that you have sold a machine. So what are the implications of selling a machine? Recoup and CGT. Do you agree? Recoup and CGT. So SARS says you've sold a machine, recoupment and CGT, no more wear and tear. He'll give you wear and tear maybe for the current year, maybe only for a piece of the current year, but after that he doesn't give you wear and tear anymore. And then you're going to lease the machine, so SARS gives you a deduction for the amount of the lease. And this is how SARS treats every sale and leaseback transaction that you do. Every single sale and leaseback transaction you do, SARS will recoup and CGT, if there was CGT, but none of the examples we've seen there was CGT. We didn't ever sell the machines at more than cost. Yeah? And he won't give you any more wear and tear. He's going to give the lessor the wear and tear. Because from his perspective, the lessor now owns the asset. Yeah? And on this lease that you're then paying, he will give you a deduction on the lease. If we look at what we do for accounting, if it's a finance lease, for accounting, we have depreciation on that side. And on this side, if it's a finance lease, we have interest expense. And those both need to be removed because SARS doesn't allow either one of those. Yeah? For accounting, we have depreciation and we have an interest expense. For what SARS will also allow is they will allow the expenses, the lease expenses, as a deduction straight away. Yeah? So you'll see that coming through as a deduction. For operating leases, we have an expense. For operating leases, we also don't have an asset. Let me just put it on that side. No, wait. We have a deferred. For operating leases over here, on this side, we have a deferred profit, which we are amorting. Do you agree? Over the period of the lease. And on this side, when we have operating leases, we have the lease expense, which is being straight-lined, if that's the case, yeah, equalized, if that's the case. So we have less of a difference with operating sale and leasebacks, because operating sale and leasebacks, SARS is going to tax us or recoup all the way back to selling price. We will have put most of that into our P&L, but there's a piece that we won't have put in P&L, isn't it? Not yet. So that's your only temporary difference, is that one. Do you agree? Over here, there's no temporary difference because this should be the same. Those two should be the same for tax purposes. Tax is actually quite easy to do for leases because for all leases, and it doesn't matter if you're the lessee or the lessor, SARS very factually. Who legally owns the asset? That person gets wear and tear. Who's paying installments? That person gets a deduction. Who's receiving installments? That person gets taxed on that income. Full stop, End of story, isn't it? So from a tax perspective, leases are easy from a tax perspective. Because for accounting, we do accounting gymnastics with leases. 7 different types of leases we've looked at. We can go back to the beginning here so I can show you. We've looked at 7 different types of leases. We've looked at a finance lease from a lessee and a lessor, an operating lease from a lessee and a lessor, and today we've looked at a manufacturing dealer lessor who has profit because he sells inventory, and we looked at when the lessee does a sell and lease back, he's actually selling his asset. In one case we do recognize the sale of an asset, the other one we don't. We sort of do like a reval on the asset. So 7 different types of leases that we do all kinds of gymnastics with. And SARS really sees it as 2 things. You're either a lessor or you're a lessee. If you're the lessor, you own the asset. It's your asset, you get wear and tear, and I'll tax you on the deductions. If you're the lessee, you're just renting an asset, I'll give you a deduction for the lease rentals that you pay. End of story. So all the deferred tax issue comes about because of how we do it for accounting, not how we do it for tax. Okay, so that's leases. The leases statement is in the pipeline to be changed. It's been in the pipeline to be changed for like 3 years. It's come up with a lot of resistance. The leases statement that's proposed or being proposed, it's an exposure draft, an ED. I'm sure it's included. No, they used to include it and then they stopped including it because it's so controversial, I think. Says, let's not distinguish between operating leases or finance leases. And then it says, let's recognize an asset for the portion of asset that you have. So what it's looking to say is, even if you enter into an operating lease and you're going to have an asset for a period of, say, 2 years, and its life is maybe 5, recognize an asset which has a value for 2 years. It's funny, hey? So the same asset would be in one person's books for 2 years, and it would be being used for those 2 years. And then the same asset would be in somebody else's books, a residual value of that asset, which is waiting for when they get it back. It's like a really funny pieces of assets scenario. So we land up with, and it's, I think, to get away from the abuse where people were not putting these assets on balance sheet. So we have assets which almost do meet asset definition because it's a resource that you control from which there will be future economic benefits. If the resource is in your hands, you do control it. Do you agree? That photocopy machine that's downstairs, we control that machine for the 2 years that we're leasing it. The fact that after 2 years we're going to give it back to somebody else and then it becomes, they can rent it again. Does it really not meet asset definition then? It goes back to framework and that real very basic thing is it an asset or not? But a lot of people in practice have come up against that, especially when you look at companies like car rentals. Do they then have to treat all their leases in that way then? They have to take their assets off balance sheet and then somebody else puts it on their balance sheet and then when I get it back, I put it back on my balance sheet. Do you know what I mean? And the valuation of those residual values. How do I decide what the value is for the first 2 years versus the value for the last 3 years? Becomes a very difficult thing. So there's a lot of controversy, and people are saying, no, that if it's a rental, it's a rental. It's definitely must be treated as a rental. So there was a time where we actually didn't have leases in this module because the new exposure draft had been issued. We were expecting a new statement. So they said, no, we only looked at finance leases. We didn't look at operating leases at all. And we didn't do any of the sell and lease backs. But then slowly they've been creeping back because it looks like that thing is very long from being finalized. But it could happen. You guys have at least 3 years, 2 or 3 years ahead of you or more until you're fully qualified, right? Because even if you do CTA in a year, you then write board the year after that and you only write board 18 months after that. So in that time, it could still change. And if it changes after that while you're doing articles, then it'll change for all your clients. So anybody that's got leases, you have to relook. Okay, so that's leases. Is that the end? No. We left with 2 small sections, segments and related parties, which we should be able to finish in one lecture next week. If we don't, we'll do segments next week. Then related parties is so small, we can do it when we start revision. Yeah. Today is week 9. We have 1 week lecture to catch up, which is last week's one. So I need to start talking to you about catch up.